You're listening to the Shaughnessy Group podcast, insights on buying, selling, and growing Canadian businesses in the lower middle market. Let's begin.
Welcome back to the Deep Dive. If you're joining us, you're here because you want to get past the headlines. And today, we are jumping straight into the very high-stakes world of private company sales. We all tend to focus on that big, exciting number when a company sells, right? The enterprise value, or EV. It's the price tag. It's the moment everyone celebrates. But here's the thing. That EV is almost never the actual amount of cash a seller gets at the closing table. It's just the starting point. There are all these critical and frankly often overlooked adjustments that happen between signing the deal and that final wire transfer. And those adjustments define what you actually get paid. So today we're doing a deep dive into the financial mechanics that determine that final number, and we're focusing specifically on working capital adjustments. These adjustments are basically the buyer's insurance policy. They ensure they're inheriting a business that's financially healthy and, ready to run from day one. Okay, let's unpack this. We talk about liquidity all the time, but for a business sale, what exactly is working capital and why is it this invisible hand that guides the final purchase price?
That is the core question, and answering it up front. I mean, that's the difference between a successful exit and a really disappointing one. Our whole mission here is to pull back the curtain on this and show you how these mechanics really impact that closing price. So start with foundation, working capital, or WC. It's simply a measure of a company's immediate operational liquidity.
So can it pay its bills next week?
Exactly. Can the business meet its short-term obligations using its short-term assets? It's the financial gas in the tank. And we calculate it by taking current assets, so things like cash, accounts receivable, inventory, and then subtracting current liabilities. That's your accounts payable, accrued expenses, things like that.
Got it. So it's the operational float. It's the money and resources available right now to keep the lights on and the staff paid, right?
Precisely. And the purpose of the adjustment is crucial. When a buyer acquires a company, they agree on a predetermined target amount for that working capital. This target is usually based on the company's historical average, maybe normalized for seasonality. If the working capital at closing is higher than that target, well, the seller gets an increase in the purchase price. But if it's lower, meaning the operational tank is running a little low, the purchase price gets reduced. This whole mechanism just ensures the buyer receives a business that doesn't immediately need a huge cash infusion just to keep running normally.
That makes perfect sense. The buyer wants to make sure the engine is fully primed. And I know the standard structure for this is the cash-free, debt-free, or CFDF model.
That's the industry standard, yes.
And the CFDF model is designed to strip out all the financing stuff so you can just focus on the real operational value of the business itself.
It simplifies the conversation.
So let's use a standard example. We'll call our company Midas Software, Inc. Let's say Midas has an enterprise value of $6 million. The basic CFDF calculation starts right there. The formula is pretty simple. Adjusted purchase price equals the enterprise value plus cash minus debt. So in a nice, easy scenario, Midas Software has $1 million in cash and about $500,000. You'll just plug in the numbers. $6 million EV plus $1 million in cash minus $500,000 in debt. The seller walks away with $6.5 million.
And if we flip that, you see the impact immediately. If Midas had, say, only $500,000 in cash, but a full $1 million in debt.
So their debt is higher than their cash.
Right. Their debt outweighs their cash. In that case, the seller receives $5.5 million. The buyer is essentially applying $500,000 of that original $6 million EV just to pay off the seller's outstanding debt. But what's really fascinating here is, well, the math is easy, but defining what actually counts as cash and what counts as debt, that's where the complexity is. That's where deals can get tricky.
I was going to say, I imagine it's never just the number on the bank statement, is it?
Absolutely not. Think about something like outstanding checks. For Midas Software, they might have written checks to vendors that just haven't cleared the bank yet.
Oh.
So are those checks a reduction in cash, or are they a liability, a piece of debt the buyer now has to cover?
I've never thought about that.
Some companies only reclassify those at the end of the year. So if you're closing mid-quarter, a buyer might come in and demand they be treated as a debt-like liability. I mean, I once spent 3 days in a closing room arguing over $15,000 in pizza delivery checks because the lawyers couldn't agree on the definition of cash balance on a Tuesday.
That is a perfect example of how the fine print matters. So if the buyer wins that argument and those uncleared checks are a liability, The seller gets all the cash in the bank, but the final proceeds are reduced by the amount of those checks.
Exactly. And this is where we hit that big aha moment for the seller. It's all about tax efficiency.
Oh, interesting. How so?
Well, it's generally much more tax efficient for you, the seller, to receive your proceeds as capital gains. They usually have a much lower marginal tax rate. If your definitions of what's cash and what's debt are vague, you could find that some of those proceeds get treated as dividends, which are often taxed at a higher ordinary income rate.
So clear documentation isn't just about making the buyer comfortable, it's about protecting your own bottom line from the tax man.
It's about maximizing what you actually get to keep.
That is a powerful incentive for preparation. So if misdefining cash costs you on taxes, let's talk about how misdefining liabilities like deferred revenue costs you on the sale price itself. This must be a huge one for a software company like Midas.
Oh, it's one of the trickiest. Deferred revenue or unearned revenue. It looks like a good thing on the surface. It's cash you've already received.
Right, money in the bank.
But because Midas software hasn't delivered the service yet, it's a liability. The company owes future work. So let's illustrate this. Let's say the historical average for Midas, the target deferred revenue, was set at $250,000. But they had a fantastic month just before closing, and the actual deferred revenue at closing jumps up to $300,000.
Okay, so Midas is now carrying $50,000 more in future obligations than it normally would. The buyer is inheriting an extra $50,000 of work.
Correct. The working capital adjustment is that difference, $300,000 minus $250,000. That $50,000 is a direct reduction to the enterprise value because the buyer is taking on that excess workload.
But hold on, Midas already collected that $300,000 in cash. Why do they have to get dinged for the future liability now? Aren't they being penalized twice? They banked the revenue, but now they're losing sale proceeds.
That's a really natural question, and it gets us into some of the technical accounting rules. When a company is acquired, the buyer has to apply what's called purchase accounting. And under GAAP, generally accepted accounting principles, the buyer has to recognize that liability based on the cost to fulfill the obligation. So they have to assume the full cost of delivering on that $300,000 of service. So here's the danger. If that deferred revenue adjustment is not specifically negotiated to use the historical target, a buyer could apply strict GAAP rules and argue that all of the deferred revenue,
The full $300,000.
the full $300,000 should be treated as a debt-like liability.
Wow. Okay, so a $300,000 reduction versus a $50,000 reduction. That's a negotiation failure that could wipe out a massive chunk of value.
It is often the biggest swing factor in subscription business sales. It just highlights how failing to define that acceptable target could be an absolute disaster. It's not about the cash you collected, it's about the buyer's future burden.
Okay, that's clear. Let's switch to the other side of the ledger. Accounts receivable. This is an asset, but what about the risk attached to it, the past due accounts?
Right. Past due accounts receivable is money that's owed to Midas, but it's overdue. It's an asset technically, but it carries a lot of collection risk. And no buyer wants to inherit a huge pile of invoices that are probably never going to get paid.
Because that would artificially inflate the working capital number.
Precisely. So we have to use a risk adjustment. Let's say Midas has a total of $100,000 in past due accounts at closing. Based on their historical collection rates, both sides agree that the acceptable past due level should be $60,000.
So $40,000 of that is considered high-risk money, money the buyer probably won't ever see.
You've got it. The adjustment is the $100,000 minus that $60,000 acceptable level. The result is a $40,000 reduction to the enterprise value, reflecting that specific risk. And again, if this isn't clearly negotiated, if you don't agree on that acceptable level, the seller's in a tough spot. Buyers will almost always argue to deduct all past due accounts from working capital, the entire $100,000.
This brings us full circle then. These adjustments aren't just, technical exercises. They are the real price negotiation happening right up until the day of closing. So here's where it gets really interesting. How does the CEO of a company like Midas prepare for this financial minefield?
Preparation is 90% of a successful closing. We can really distill the best practices into 4 key areas, and they're all focused on turning complexity into clarity.
All right, let's start with the foundation, establishing clear targets.
You absolutely must define your working capital targets before you even enter negotiations. And this isn't just pulling a number from last month's statement. You have to factor in historical performance, account for your company's seasonality,
Right. If you're a retail business, December looks very different from February.
Exactly. If you can't define what normal looks like for your business, the abnormal is going to cost you money.
Okay, so once that target is set, the second key practice has to be documentation. You need the proof.
Detailed documentation is completely non-negotiable. You need extensive records on all of it. For accounts receivable, you need historical data showing, what percentage of accounts over 90 days past due you actually end up collecting. That data proves your historical average is legitimate. It makes it defensible.
And practice number 3 gets into the legal agreement itself, defining the process.
This is your absolute best friend. The purchase agreement has to clearly outline the exact methodology. You need to nail down every definition. What is past due? Is it 30 days? 60 days? What method are we using for deferred revenue? Ambiguity is the enemy. It is the #1 trigger for post-closing disputes.
Which leads right into the final point. Because disputes are almost inevitable when this much money is on the line, you need a resolution mechanism.
That's the crucial 4th practice. You have to establish a process for resolving disagreements. This usually means designating an independent third-party expert, like a neutral accounting firm, for binding arbitration. This ensures that if you can't agree on that final number, the whole deal doesn't collapse. You have a professional referee ready to step in. At the end of the day, managing these adjustments is just vital for protecting the true value of your business. Preparation transforms what can be a really contentious, messy process into a smooth transition, and it ensures you, the seller, get the value you actually earned.
What a fantastic deep dive into those closing mechanics. So, to wrap up, the thing for you to remember is this. The enterprise value is the price tag for the business, but the price you actually receive is a moving target. It's heavily influenced by liquidity, by liabilities like unearned revenue and old debts.
And it's the definition, the documentation, and the management of those variables that dictates the final cash you get.
So here's the provocative thought we'll leave you with today. Maximizing your final sale price is often less about boosting that headline earnings figure in the last quarter and far more about meticulously managing the financial plumbing and ensuring you have impeccable definitions leading up to that closing date. The enterprise value is the big number, sure, but the working capital adjustment is the fine print that defines the true operational burden or benefit a buyer inherits. We want to thank Shaughnessy Group for providing these crucial insights into managing the complexities of private company sales. If you're navigating an acquisition or an exit and you need some expert guidance, you can visit their website for more resources. That's shaughnessy.group. Until next time, keep digging deeper.
This podcast is for informational purposes only and is not professional advice. Consult qualified advisors for your specific situation.